Hello and welcome to CFA Society New York's podcast, Compound Insights. I'm your host, Rob Rowan. As regular listeners to this podcast know, I normally like to frame the topic. But the muni market is so big that it defies framing. It funds everything from water to schools to roads to stadia. However, there are some challenges that we are set to talk about today with one of the greatest resources we have in the industry. Pat Luby is the Senior Municipal Bond Strategist at CreditSights, which does independent fixed income credit research. Now, while Pat covers munis, CreditSights also covers the investment grade, high yield, distressed, and emerging markets sovereign markets. Pat serves on the board of directors of the Municipal Analyst Group of New York, which as many of you know as I do of Magni, and is a member of the National Federation of Municipal Analysts. So, Pat, thank you for being here.
Hey, Rob, thanks very much. Appreciate the opportunity to speak with your members today.
Yeah, it's going to be a fun one. One of the big issues that we talked about that is going to be affecting the municipal markets is inflation if it is sustained. So how do you think muni issuers will handle it in the near term?
Well, for issuers, it's a really important question. For issuers, it's potentially positive for some issuers. They'll see revenues boosted by rising inflation, some sooner rather than later. So toll roads, electric utilities may see their revenues boosted, or it might be easier in an inflationary environment for them to raise revenues, raise rates if necessary. But local government issues that rely on property taxes will also see increased property tax collections as assessed valuations rise along with inflation. The states, which rely on income taxes and sales taxes, should also see an increase in revenue streams as well. For issuers that have large pension funding gaps, however, inflation can be cut two ways. So it can help by inflating current tax revenues that could help make more funds available to pay pension costs. That is, so long as pension COLAs don't rise faster than tax revenues. That's a concern, and certainly one that analysts should be looking carefully at when looking at a credit. But inflation should also boost equity and real estate investments in pension portfolios, which could help narrow the funding gap as well. So that's probably the more likely benefit to issuers there. It's certainly a major source of financial strain. The major challenge for issuers that have large capital improvement plans that will need to be funded by debt, since future construction costs will be higher. It'll take more debt to fully fund projects that maybe they've already broken ground on and haven't finished financing. Inflation from the investor's perspective, though, is different. We need to be mindful that investors need to be looking at real rates of return, which really has not been a topic in the municipal market for a very long time. The bigger risk that I see is the behavioral response of individual investors and advisors. Investors may be tempted to underweight duration or even reduce fixed income exposure, which can reduce portfolio diversification and, of course, increase portfolio volatility. If individual investors respond by exiting municipal bond mutual funds, depending on the scale and the duration of redemptions, the limited amount of secondary market liquidity in the municipal bond marketplace could easily be overwhelmed by selling from mutual funds, which would create a cycle of increased volatility, further pressuring prices lower and frightening even more investors into redeeming mutual fund shares.
Right.
But,
yeah. But that's what we used to call 1-800 redemption.
Exactly. But if you go back to last March when the pandemic volatility was really extreme, and mutual funds had one of the largest, may have been the largest month ever of net outflows, 42 billion of outflows from mutual funds. It was also one of the largest months ever for gross new purchases of municipal bond mutual funds. Mm-hmm. There are a lot of investors who saw the increase in yields as an opportunity to lock in some income. So if yields do rise, some income-starved investors will be buyers. And if prices fall enough to make tax-exempt yields competitive with comparably rated corporate bonds, I would expect investment-grade taxable fixed income investors would step into tax exempts. They are not in the market right now.
Okay, let me unpack that a little bit for our listeners because you said a lot of different things there. That was great, but I just want to take a couple quick steps back. So, it sounded like you said that inflation could be possibly positive for public power issuers, but aren't all the means of some of their production also going to rise, and maybe will that net out some of the impact, even though they will have more flexibility on the rate setting side?
It really is issuer specific. For public power issuers that have needed capital improvement plans, either in the works or on the drawing board, it's a potential concern. But of course, they should have greater flexibility in raising rates to cover it. But it does introduce an element of uncertainty. I mean, you need to look no further than the state of Texas, which was surprised by the severity of the cold weather last year. And that's going to require some capital improvements, and those things will be more expensive. As you framed up earlier, the muni market is a collection of many different marketplaces. It's very idiosyncratic. It becomes really, really important for credit analysts to roll up their sleeves, take a hard look, and look at the disclosures, but also look beyond the disclosures. What's in the headlines? A lot of issuers don't necessarily do an adequate or sufficient job about disclosing risks that may be going on. And so the human element of a seasoned analyst becomes really, really important.
Right. I'm glad you mentioned that. That is sort of the trick of going from good to great in credit analysts, is the human part of it for sure. And just a quick follow-up question for that. Now, I wonder, perhaps it's not only the issuers that have had a disaster of some kind that have a risk of inflation also. The locality that I'm sitting in, New York City, has a sort of mind-blowing agenda for capital improvements in the near term, and doesn't have a lot of flexibility in terms of raising property taxes because of the relatively sideways direction of the housing market. So how do you see that unfolding for the ones that haven't had these sort of big headline disasters?
I think that actually points out one of the characteristics of the municipal bond market that makes it so different from the corporate market is it's a collection of governments that is staffed by professionals who want to make things work. And so the history of local government, the history of state government, city government is dealing with the problems as they come along. It would be overwhelming if we asked them to deal with risks that could happen 5 or 10 years down the road. They've got their hands full right now, just making sure that the city gets through the pandemic, that the lights stay on, everything else. I think it really comes down to the willingness to pay. Analysts are accustomed to looking at the ability to pay, which is really, really important. When the margin of safety on the ability to pay becomes thin or negative, an issuer that has demonstrated willingness to pay can be embraced by the market, whereas a high quality issuer that has abundant willingness to pay, or ability to pay rather, but has demonstrated reluctance to protect and defend the promise that they've made to bondholders, they're going to have a more challenging time. So I think the key story really is, we haven't talked about ESG, but this is all about the G in ESG. Right. It's the governance, and what are the processes, procedures in place around governance that suggests to investors that there's an attitude towards dealing with problems as they come up and trying to get them fixed so that we can continue.
Well, at the end there, you talked a little bit about portfolio construction, and I do want to talk about higher rates, not only from the portfolio side, but also from the issuer side. It seems to me that some of the munis could borrow substantial amounts of money at very, very low rates when rates were low, but some of them couldn't. And I wonder how you see them rolling with this trend, particularly as costs are rising to comply or handle some of the ESG risks, for instance, that are out there?
So this is almost another quirk of the muni market. Muni spreads, the credit spreads, the risk spreads are very tight. Even high yield muni spreads are very tight. So the few projects that have been challenged and being able to line up financing are going to face an even bigger challenge, because if we come into a rising rate environment, you have to expect that credit spreads will widen a little bit. Maybe it'll be a function of demand and what's going on with treasury rates, but I think it's not reasonable to expect that spreads which are already very tight could compress further. So right. I think these projects that have been challenged to line up financing, they're going to face an even bigger challenge going forward if their pro forma debt service costs go up, or worse, they feel compelled to stretch their amortization out over a longer period of time to make the numbers work. That's going to be really, really hard. But this part of the new issue market in munis presents a particular challenge because demand has been so strong for so long. You know, the rate environment where we have everybody starved for income, investors have been flocking, money has been flocking into the high yield part of the market. And it's not a very large part of the market. And so every incremental dollar that comes into high yield has a disproportionate influence on the spreads. Right. So portfolio managers have had a hard time getting their hands on paper. They may have had to hold their nose a little bit just to be able to get money invested. Our approach at CreditSights when discussing credits is to establish an opinion about the credit and to form a separate opinion about the relative value. How do we think this should be priced? Sometimes the reward is simply not sufficient or appropriate for the level of risk. That doesn't necessarily mean you shouldn't buy it, but it means that you need to have your eyes wide open when you buy it, because when the market has been in good health, it's liquid, but the muni market is very thinly traded, and if market conditions become challenging, liquidity evaporates, and these marginal credits are the ones that suffer the greatest.
Right. So I wonder if you have any thoughts on that, on the federal infrastructure bill, which as we are recording it has an uncertain future, but is looking like something that might come along. Do you think that those at the more high yield end of the spectrum have more to gain from the certainty of federal checks, or do you think that the larger portfolios of projects at some of the higher level credits have more to gain, or is it sort of all over the place?
I think it's kind of all over the place. You know, the infrastructure bill which did pass did have spending in there for infrastructure, but it was not life altering. It's $550 billion spread over 5 years, and that was really for traditional infrastructure. Some of the elements that have been in the Build Back Better bill arguably would be good for society and indirectly good for credit, but not a lot of direct impact on muni credit. I think the longer term implications, regardless of whether between now and when this gets broadcast, the bill comes back or gets rehabilitated in a different shape. It's a reminder to government finance officers and to investors that relying on the federal government to fund infrastructure is not a panacea. Municipal bonds have been financing infrastructure for 100 years. Individual investors have been providing capital to fund infrastructure investments in the local community. Members of Congress who come out of state and local government understand that. That's why they're big proponents of the municipal bond market. I think that well-run issuers are going to continue with what they're trying to do to serve their local communities. And if they can get the federal government to pick up some of the tab, they will, but they can't wait for the federal government. So I think we'll see issuers proceeding with whatever that is that they need to do, and they'll proceed with infrastructure plans. What we saw in the municipal market early in 2021 A lot of issuers were selling taxable bonds to refinance older, higher coupon rate debt because they're looking to free up cash flow,
Right.
not knowing what the implications were. When it appeared that the federal government was going to restore the ability to issue tax-exempt advance refunding bonds, the issuance of taxable munis slowed down because I think a lot of issuers are thinking, well, we'll wait for this to pass and then we'll be able to issue tax-exempt advance refunding bonds. And of course, that didn't materialize. It doesn't look like it's going to materialize. So waiting on Washington, you can be waiting a long time. I think local governments need to stay the course.
You're right. How long have we been waiting for a national PPP framework?
Mm-hmm. Yeah.
So, yeah, definitely a part of it. Well, I do want to shift a little bit because, the other thing that is interesting, and you mentioned this earlier, is the amount of muni issuance, both refunding and new. SIFMA shows that it's been cooking along this year and took a little bit of an end of the year decline in November, but has been around the $400 billion range since the beginning of this year. So where do you see that going in the near term, and what do you think the impact of that is beyond the things we've already talked about?
So this year's new issue volume is setting a new record after last year's record issuance. I honestly, at the beginning of 2021, thought that we would see a lot more taxable municipal issuance. I touched on that already, that some of the things that undermine that. But we think that the pace of new money borrowing is going to increase. So this year's new money financings was up over last year. It's up over the 5-year average. We think it's going to continue to tick up a little bit. If you look at the muni market on an inflation-adjusted basis, the market has contracted. Infrastructure needs have not contracted. Recent report we put out on the state of Connecticut pointed out that the state of Connecticut, the total amount of GO debt they have outstanding has shrunk, and that's not unusual. There are issuers that have allowed their amount of debt to contract. So there's untapped borrowing potential, and there's plenty of infrastructure needs. So we're looking for new money financing borrowing to increase in 2022 from the pace of 2021. I think issuers will continue to issue current refunding and advanced refunding bonds to refinance older, higher rate debt. I do think that we'll see an increase in taxable financing to be able to get that done. I don't think issuers can afford to wait, particularly with the prospects for a higher treasury rate environment. I think moving sooner rather than later has some benefits for issuers. And so I think we'll see a good amount of refinancing activity. I think that we'll see more taxable issuance in 2022 than we saw in 2021.
Wow.
The implications for that are for those investors who want to buy tax-exempt munis. An increase in municipal issuance doesn't mean it's going to be easier to buy tax-exempt. This would actually mean it could be more difficult. And of course, as new bonds are issued to pay off older bonds, that means bonds are going to get called out of portfolios.
Right. Okay. So they net out. Yeah.
Yeah.
Fascinating. All right. So I will link to that report into our show notes for this event so that people who are listening can read it. That is fascinating because, as a lot of people know, the credit spectrum in Connecticut amongst the different munis is pretty big.
Mm-hmm. Yep.
And it's fascinating. The last question I had for you was just a sort of interesting one because we talked a little bit throughout this about the progression of a credit analyst. The credit analysis position now is much different than when I started in it a long time ago, and because of the advent of different types of data handling and data strung. So if you were advising someone who was fresh out of school and said, a moment in their junior year when they said, you know what, I want to be a credit analyst, would you tell them to take Python? Like, what would you tell them to do?
Oh, absolutely. I think everybody needs to be conversant in Python, even if you're not coding. Every firm on the street uses Python to massage their data, or to massage their portfolios or market data. So at the very least, it's important to be conversant in what Python can do. There's, I think, a perception among some seasoned analysts that the encroachment of data is a career risk for credit analysts. And I couldn't disagree more. Data is only data, and data is not forward-looking. It can get really close to real time, but a credit analyst has to figure out, well, what's the margin of safety? How comfortable am I that this promise to pay will be sufficient 5 or 10 years from now? And that's a lot more than just what sales tax collections are this month or this quarter, or what convention center revenues are. And it involves a whole lot more. So I think the human element becomes even more important. Read broadly, pay attention to the news, pay attention to all of the things that the smartest people are paying attention to. What's going on with the weather? What's going on with the climate? How are things being described? And so having a well-honed analytical toolkit is really, really important. But having the ability to form an opinion and to express that opinion clearly and distinctly is really, really important. You don't necessarily have to be right every time, but I think if you approach it with a sense of transparency, here's my opinion, here's the data that supports it, this is why I feel really strongly about it. Poke holes in it, if you will. So I think don't be afraid of the data, embrace all of the tools that are coming along, and be able to explain the benefits of having a human credit analyst. One of the analogies I go back to again and again, and I have a daughter who's a physician, so I really like this analogy. I've used it a lot through the years. If you're sick, if you're a little sick, then you're going to go to the doc in the box around the corner, get an antibiotic or swab or whatever. Mm-hmm. But if you're really sick, you want to go see a doctor. You want to go to a doctor you trust, who's got credentials, who has experience, not just credentials, but experience, and perhaps in an area of expertise. You want to talk to a really well-qualified physician. In the bond market, all we have is the promise to pay. There's no fiduciary obligation. It's just a promise to pay. And so I think it's really, really important to cultivate that experience and be willing to offer an opinion, because that's what physicians do, is they offer an opinion. Here's what I think is going on. That's what credit analysts do.
True. And for physicians and credit analysts, being right doesn't hurt either.
It definitely helps. It definitely helps. But both of them involve taking as much data as possible, not waiting for the perfect set of data, and being willing to take your experience and interpolate or extrapolate based on that data to form an opinion.
Great. Thank you, Pat, for that. That is, just one of the funny things about how all of our jobs in finance are changing right now. It's not just credit analysts, but a lot of jobs are changing. Mm-hmm. I think this is a very important thing to remember. But thank you for that. So, to the audience, I'd just like to say that you be sure to look out for our next podcast episode. It is an interview with Darnell Aziz, Florida Abbott, who has a lot more thoughts on inflation's broader impact on the markets. That will drop on February 7th, 2022. If you're listening to this episode on our website, please consider subscribing on Apple Podcasts, Google Play, or wherever you like to find your podcasts. Thank you all for listening. Until next time, I'm Rob Rowan.